The world didn't see it coming. One signature in Washington and three economies cracked open overnight. Scott Bessent fires off a $20 billion order to save Argentina's peso. Hours later, Australia's biggest miner quietly accepts Chinese yuan, breaking a century of dollar rule. And by dawn in Tokyo, the yen free falls past 152. Panic on trading floors. Silence in the central bank. 3 continents, one night, and the dollar supremacy just took a direct hit. That same afternoon, across the Pacific, Australia's mining giant BHP confirmed something unthinkable a decade ago. Its latest iron ore cargo to China had settled entirely in RMB. The announcement appeared on the Shanghai Clearing Bank's ledger, verified by the People's Bank of China, and quietly acknowledged by Canberra. It was the first high-value Australian commodity shipment priced and paid in Chinese currency, not US dollars. The simultaneity of these moves, Washington defending the dollar in South America, while Beijing expanded its use in Oceania, wasn't lost on traders. The Wall Street Journal described it as 2 opposite monetary fronts forming at once. Bessent's decision to deploy the Exchange Stabilization Fund was framed as fiscal triage. But inside the Treasury, it also reflected growing concern that China's regional settlements were eroding dollar liquidity. Argentina's reserves had dropped below $1 billion by late September, according to central bank filings seen by Bloomberg. Inflation exceeded 180% year-on-year, the highest in Latin America. President Javier Milei's government had already abandoned multiple import licensing systems just to secure grain shipments. The U.S. swap line, Bessent said, was to prevent systemic spillovers, yet every major financial paper questioned whether it marked a return to U.S. currency policing. In Washington hearings, Senator Elizabeth Warren demanded clarity who profited when U.S. funds propped up a collapsing peso. She cited hedge fund exposure in emerging market bonds, arguing that Treasury rescues might buy time for private investors to exit safely. The comment echoed across CNBC and MarketWatch, and within hours, bond desks in London began testing the peso's limits. Traders shorted the currency, betting Bessent wouldn't have political backing for another round. Meanwhile, Beijing moved in silence. The China Daily reported that the Bank of China's Sydney branch cleared record renminbi volumes in September, up 38% month-on-month. Australia's Department of Industry estimated that more than $45 billion in annual iron ore exports could theoretically shift to yuan pricing within 2 years if settlement friction stayed low. For China, this was less about optics than insulation, reducing exposure to Trump-era tariffs and dollar volatility. Bessent's background mattered here. Before Treasury, he managed Soros Fund's macro book during the 1992 sterling crisis. He once wrote that currency defense works until politics intervenes. That line resurfaced in a Financial Times editorial questioning whether the United States was repeating Britain's pre-Euro missteps, using reserves to defend a currency framework while competitors built alternative systems. By early October, Argentina's 2035 bonds were yielding 13.4%, according to Refinitiv data. Fitch Ratings maintained a CCC- grade outlook, junk territory, but noted temporary support from extraordinary United States liquidity. The phrase extraordinary underscored how far from normal the arrangement was. Across the Pacific, BHP's renminbi decision rippled through commodity circles. The Financial Review quoted unnamed executives at Rio Tinto saying they were assessing pricing flexibility under new Chinese clearing incentives. For miners, denominating in yuan lowered hedging costs by up to 20%, according to an internal ANZ bank estimate cited by Reuters on October 9th. But it also tied them closer to Beijing's monetary cycles, an exposure once considered unthinkable for Australian firms. Let's pause, because this wasn't supposed to happen. Not yet. The United States was meant to be the liquidity backstop of last resort. China, the trade surplus giant, still constrained by capital controls. Yet the sequence now runs in reverse. Bessent injecting dollars to preserve influence. Beijing exporting currency to expand it. At this midpoint, something even sharper unfolded. On October 10th, the People's Bank of China formally included Australia in its cross-border interbank payment system upgrade, enabling instant renminbi settlements through local banks. The same day, Japan's yen hit its weakest level since 1990. Bloomberg Economics noted that Tokyo's Ministry of Finance had spent over 5 trillion yen, or $33 billion, defending the yen in the previous week alone. Still, the currency fell another 0.8%. Japan's political transition accelerated the slide. Following Fumio Kishida's resignation, Sanae Takaichi took office pledging unlimited fiscal mobilization. She rejected interest rate hikes, calling them anti-growth dogma. The Nikkei 225 rallied on stimulus hopes, but the bond market cracked. 10-year Japanese government bond yields spiked 17 basis points in a day, the steepest move since the 2016 yield curve experiment. IMF data released October 11th showed Japan's gross government debt at 235% of GDP. Foreign ownership of Japanese government bonds fell to 5.7%, the lowest in 15 years. That left the Bank of Japan holding more than half of all outstanding debt, effectively monetizing deficits. Analysts at Nomura warned that if the yen slipped below 155, a second-order effect could force Japanese insurers to dump United States treasuries to cover foreign exchange losses. Back in Washington, Bessent's messaging really hardened. The dollar's credibility, he told CNBC, is not sustained by words. It's sustained by our willingness to act. He insisted that swap lines weren't bailouts, but, as he put it, reciprocal confidence tools. Yet, Bloomberg calculations showed the Treasury's cumulative exposure through such lines now exceeded $65 billion across emerging markets, up from just $12 billion a year earlier. Australia's Reserve Bank reacted cautiously. In a briefing quoted by the Australian Financial Review, officials said RMB settlements remained commercial decisions but did acknowledge that currency diversification could reduce systemic dollar risk. Privately, several former RBA governors told reporters the shift was inevitable once China controlled both demand and payment infrastructure. By October, China's Ministry of Commerce confirmed that 18 countries had concluded partial trade deals denominated in RMB, up from 11 in 2023. The U.S. Treasury's own internal memo, leaked to Politico, warned that de-dollarization was accelerating faster than modeled. The paradox grew clear. Every dollar Bessent deployed abroad strengthened the perception that others needed alternatives. In effect, defending the dollar showcased its fragility. Japan's predicament deepened. The yen's fall made exports temporarily cheaper, boosting automakers' margins, but energy import costs exploded. LNG contracts indexed to the dollar surged 12% in yen terms within a month. Households saw electricity bills jump 15%, the fastest pace since 2014. Local media began referring to the phenomenon as imported inflation. The Financial Times quoted former BOJ official Kazuo Ueda, saying, "The government's fiscal expansion and the bank's yield control cannot coexist indefinitely." But Prime Minister Takaichi dismissed such warnings, framing the weak yen as a necessary shield against external tariffs. Meanwhile, Australia's Treasury quietly revised its foreign exchange reserve composition. According to Bloomberg data, the share of RMB assets rose from 6 to 9% in the third quarter of 2025, the largest quarterly jump on record. Officials said the adjustment aligns with evolving trade realities. In Argentina, inflation temporarily slowed to 9% monthly after Bessent's intervention, but the respite looked thin. In London, futures traders began pricing yuan-denominated iron ore contracts at a discount to dollar ones, a sign that markets now saw RMB liquidity as viable. Inside the White House, aides debated whether Bessent's interventions violated Trump's campaign pledge of no taxpayer rescues abroad. A Treasury spokesperson insisted all operations were fully collateralized, yet congressional critics questioned their transparency. China's state newswire Xinhua ran a pointed headline, "U.S. Treasury prints confidence, not stability." The piece concluded that Beijing's currency diplomacy had outpaced Washington's currency coercion. In Sydney, BHP shares climbed 3.8% after the RMB announcement, reflecting investor belief that China-linked contracts secured longer-term revenue certainty. The Australian Financial Review called it a new financial geography, less London, more Shanghai. Japan's Ministry of Finance, however, faced the opposite. The yen's weakness forced emergency purchases of US dollars to slow the descent, but analysts estimated reserves fell by $40 billion in 2 weeks. The Wall Street Journal warned that Japan's self-financing illusion could unwind if confidence breaks. Even the IMF entered the debate. In a note released October 12th, it stated, "Persistent use of currency swap arrangements to sustain bilateral influence may fragment global liquidity." It was a rare public caution directed implicitly at Washington. That evening, Treasury staff briefed reporters under condition of anonymity. Bessent would not authorize further swaps without reciprocal market reforms. But markets already sensed the contradiction. Conditional support undermines deterrence. Across Asia, central banks recalibrated. Indonesia expanded its RMB settlement window, and Malaysia announced a new Yuan ringgit corridor. According to Bloomberg's tracker, RMB's share in Asian trade finance rose to 5.4% from 3.2% a year earlier. Japan's yen closed at 152.45, which, interestingly, coincided with another record. The USD index hit 107.6. Ironically, while the dollar strengthened globally, its legitimacy as a neutral medium was being questioned. Argentina's second auction of short-term bills failed to meet subscription targets, compelling another dip into Bessent's swap line. Meanwhile, Australia finalized plans to issue a pilot RMB bond through its sovereign wealth fund, the first Western AAA issuer to do so. Reuters confirmed it was underwritten jointly by CICC and ANZ. By late evening, Bessent appeared again on Fox Business. "This isn't a war of currencies," he said. "It's a war of credibility." Yet even his choice of words betrayed the tension. Markets reacted instantly. The yen slid further. RMB forwards firmed and Argentina's peso wobbled despite new dollars. In 24 hours, three currencies told one story: the dollar's assertiveness, the yuan's reach, and the yen's retreat. As trading screens flickered across Tokyo, Sydney, and New York, a question hovered that no official wanted to voice. If credibility is the currency now, who prints it next? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.